Hello, chart watchers, and welcome to this Tuesday, February 20th, Market Watchers live show with your hosts, Tom Bowley and Arthur Hill. Erin Swinlin is off today, and she'll be back tomorrow. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we are starting a new week, kind of looking early like I thought we might look. Kind of ended last week a little bearishly, started a little bit to the downside today, but the good news is the market is trying to rebound. We see the Dow Jones Industrial Average down 69 points currently. S&P 500 has moved into positive territory, up 3 points. The NASDAQ doing very well on a relative basis, up 52 points. And the Russell 2000 currently moving back into positive territory as well, up a couple of points. 10-year Treasury yield now at 2.91%, challenging the highs that we saw last week. Volatility index is on the rise today, so that is something to keep an eye on. It is up about 2.7%, close to 20, that 20 level. We got down to about 17 and change, but we have managed to move back higher. The XLK technology ETF and the XLY, which is consumer discretionary ETF, these are two of the areas leading the market advance today, which is good news. Those are both aggressive areas. Consumer staples, however, and utilities are lagging. Although you can see that consumer staples has rallied off of its earlier low today, which is good. Leading technology today is the semiconductor group. And NVIDIA, you can see trying to make a very critical breakout above the late January highs. And Applied Materials also having a really strong day today, challenging those late January highs as well. And with that, I'm going to bring in my co-host, Arthur Hill. Nice to have you on the show today, Arthur.
Hey, Tom, it's great to be here.
Yeah, this is really cool. I mean, you know, you're over in Belgium. You're giving up your dinner time with your family to be with us today. And I know all of our listeners are certainly appreciative of that. How's it been going?
It's been going good. You know, there's never a dull never a dull moment in these markets, especially over the last few weeks. So, you know, it's always staying interesting. That's for sure.
Yeah, I mean, we kind of have a market right now that we're facing that, you know, we haven't seen in a while. I mean, everyone, and I know you've talked about this before, and it's true. You sit back and you know that the market's overbought. You know it needs a pullback or correction, but then once it corrects, you know, at first when you're expecting that correction, you're like, okay, well, when it pulls back, I'm going to get in. I'm going to jump in. But then you get that pullback and you see the volatility index shoot up to 50 and you're like, wow, how low is this thing going to go? You know, I don't want to jump in too soon. And then we get the bounce back and then you're like, well, do I get in on the bounce back? It's just this mind game now that we have to deal with that we haven't really had for the past probably a year or two.
Well, you hit the nail on the head because the pullback was like, you know, 10% in 10 days. Yep. It was a really sharp downdraft. And then we had like a 6% bounce in 6 days. So an equally, well, not equally, but, you know, another sharp move on the upside to rebound. And about the only thing we can take away for sure is that volatility's back.
Yes, it is definitely back. And I tell you what, you know, everybody has their own opinions right now as to what's going on in the market. You know, is this a bear market? Is it a correction? Are we just going to keep, you know, shooting higher? I mean, the market's bouncing back today after being weak at the start. You know, what do you do in this kind of market? So we're going to have some really interesting discussions later in the show talking about exactly what you think this market is doing. So you do have like, you know, a couple more minutes where you can exit if you don't want to have to be put on the spot. Otherwise, I'm going to ask you for all your opinions on what's going on in the market, what to expect going forward.
Okay.
Looking forward to that. But we're going to get into all that in a couple minutes. Let's move on. We do have some announcements quickly to get into this week. Tomorrow, Greg Schnell is going to be joining Market Watchers Live. Always a great show with Greg. Then on Thursday, our schedule's kind of mixed up a little bit this week, but everything stock charts will be on Thursday. And then I'm going to do a workshop on Friday. I don't know what I'm going to do. I'll tell you what, I'm going to open it up to everyone again. If you fill out the survey at the end of the show and just give me some ideas as to, you know, maybe what to do a workshop on this Friday, I'll certainly take that into consideration. The last time we did have some comments about using the chart style buttons and some of the different ways to use stock charts. And I thought that was a great topic, and I ended up going with that. So if you have ideas, feel free to pass them along, and we'll come up with a decision for Friday's workshop. Today's agenda, Arthur and I are going to talk about the state of the market. It's kind of like a State of the Union address, except this one's on the stock market. So we're going to each take turns talking about what we see in the market right now, what we're expecting, and I think it'll be a really interesting discussion. Then Arthur's going to share using the Fibonacci tool with everyone. He's got some interesting Fibonacci charts, and he's going to show you how he sets it up. Really interesting segment today. Then, of course, we'll get into the 10 in 10 to 1, where our first symbol today will be Advanced Micro Devices, AMD, in that semiconductor space that's on fire today. So we'll take a look and see where AMD stands and what to look for going forward. And then finally, Arthur and I are going to have an agree or disagree segment. Not going to get into exactly what it is, but let me just say it has to do with gold. So for those of you who are interested in gold, I think you'll find the last agree or disagree segment to be very interesting. And with that, I'm going to go ahead and jump into some of the technical headlines and news today. First off, I always like to start off with the 10-year Treasury yield. So let's get a quick update here and see where we are. We're sitting at 2.91%. As I mentioned earlier in the show, we are right up against some key resistance on the 10-year Treasury yield. And of course, if we break out to the upside on the yield, it's telling us that money is coming out of the bond market. And typically, when you're seeing money come out of the bond market, it tends to find its way into the equity market. Now, February, that has not really been the case. We've seen some volatility, but overall, we have been moving higher on the yield, suggesting money is coming out of the bond market, but everyone's so nervous, they're not putting it in the stock market. The stock market's actually been going down with the bond market, which is really interesting as we approach the 3% level on the 10-year Treasury yield.
And Tom, as you noted, the utilities were down today. So they're interest rate sensitive and they're taking a bit of a hit as the 10-year approaches 3%.
Yep, very interesting to see the utilities XLU rolling back over. We did make a technical move on Friday on the XLU, moving back above the 20-day moving average. And we do have a positive divergence, by the way, on the PPO. You've got lower prices, got a slightly higher PPO. So on that move back up above the 20, I said last week, I thought maybe we might move to about 51 and a quarter to challenge the late January high, maybe get a 50-day test, and at the same time, maybe see this PPO work its way back up toward a centerline retest. But we, as Arthur just mentioned, you can see the XLU, one of the lagging sectors today, and I think this is the weakest right now, down 1.48%, even though the market's reversed. And I think the question technically here is whether or not the XLU can hold that 20-day moving average after moving above it on Friday. We'll see as we get through the day whether or not that, in fact, is the case. Now, I mentioned with the technology stocks earlier today that semiconductors are having a strong day. And take a look at this chart. I didn't like that candle that printed on Friday. We saw this across many areas of the market where we had an inverted hammer. A lot of times at a bottom, you'll see a hammer form, and then you see buying resume. Well, a lot of times off the top, and we saw this on the first reaction high from all the selling, you got this pushed back to the upside on the semis, put in an inverted hammer, and then we moved back down off of it. But look at this one that formed on Friday. We did gap down a little bit, so I guess technically it did work, quote unquote. But we have seen semiconductors rally back very strongly today, up 2.37%, 80 points almost, back above the 3,400 level, taking out that Friday high. And now really the only thing up ahead is the late January highs that came in between 3,500 and 3,550. Talking about some of the semiconductors in this space that really are looking good earlier today, NVIDIA trying to make a breakout. You can see right now it is at an all-time high. Volume today is not light either. This is a nice volume move to the upside. The PPO is strengthening once again. Technically, yes, you do have higher prices and a lower PPO, so there's a negative divergence. But for me, it's really hard for me to get behind the slowing momentum theory when you're breaking out and you got heavy volume on that move to the upside. So
yeah, the new high is definitely an important thing here.
Yeah, clearly with this move to the upside. Is NVIDIA, I know you'd like to follow trends, obviously, Arthur, and But you do mostly ETFs. Is that correct? Or do you still trade individual stocks?
I do individual stocks as well, and I would be looking at the leaders. And NVIDIA is definitely one of them because they were one of the first ones, to move back above their moving averages.
Now, when you talk about leadership and leaders, are you talking about stocks that are simply outperforming the benchmark S&P, or stocks that are outperforming their peers within their industry group, or both?
Well, usually stocks that are hitting new highs on the price chart. They're closest to new highs relative to other stocks. And mostly I do relative to the benchmark, say the S&P 500. And if they're, outperforming the S&P 500, that's enough for me.
Yeah, and for those of you maybe who are unfamiliar, one way to do this is simply to put in this ticker symbol, $, SPX. And then when I do these relative charts, candlesticks to me just make a lot of noise. I just want to see the solid line and which direction it's heading. And this is exactly what Arthur was just talking about. I mean, NVIDIA, I think you can clearly see that this is a stock that not only has been outperforming recently, but we could pull up a long-term chart on NVIDIA. And let me do this. Let's pull up a weekly chart. We'll go back. Let's go back 10 years on NVIDIA. I think you'll see that it's really started to outperform in the last few years. And then the other thing I want to bring up here is let's put in, this is something that Greg Schnell likes to talk about and uses quite a bit, the scooter line. And I'm going to move that up here. And let's take a look at where NVIDIA is on the scooter, because that's another way of looking at strength. All right, what did I've got a relative chart. Never mind. We'll look at the scooter in just a minute. Here is the long-term chart on NVIDIA relative to the S&P 500. And I think you can clearly see that it was about 2.5 years ago that we started to make a breakout against the S&P. And yes, we have a couple of periods where the NVIDIA just pauses for a little bit, but then quickly resumes its move to the upside. And that's exactly what we've seen here recently, here in 2018. NVIDIA paused with the overall market, but I think, Arthur, you made a great point. NVIDIA is breaking out to a new high. The S&P is not breaking out to a new high, but NVIDIA is. So we're seeing that relative strength. Now, again, if I go back in here, I want to pull up that scooter now. So let's take a look at the 10-year chart and point out a little bit how Greg Schnell likes to use the scooter. He likes, when we see a stock move back up above, say 70, 75 on that scooter line, that is generally a good indication that you've got a stock that's beginning to outperform and is worth considering. Here is the scooter. Now you can see a lot of back and forth, but check out over the last 2.5 years as we were making that relative breakout. Look at the scooter move up into that hot zone above 70, 75. And notice each time we've pulled back to around 70 or 75, that has been a great time to get involved in NVIDIA. So this is the type of stock I'm assuming, Arthur, that if you were going to trade an individual stock, it would be one like NVIDIA. It's certainly a leader.
Yeah, definitely be at the top of my watch list.
All right. A couple other stocks within the semiconductor space. I mentioned Applied Materials earlier. This is another one that's having a really strong move as the market has moved back to the upside. Applied Materials is doing what I'm kind of looking for in the market. We'll get into the state of the market in a little bit, but I'm still pretty bullish the market. I think we're going through a phase that we desperately needed. We were very overbought. I think we're consolidating for a while. It's probably going to get really frustrating because I don't think it's going to be a V bottom where we just go straight back up, but I'm not ruling that out either. But one thing I see with Applied Materials is after setting a high back in November, and this was earnings related, we had a big gap up on heavy volume. And anytime you see a big red candle, especially with heavy volume, that tends to mark a pretty important resistance area. So I think what we did is we topped there. We put in the left side of an inverse head and shoulder, possibly here, the left shoulder anyway. Here was a move back up, possibly left side of a neckline. Lower low prints that inverse head. And now here comes Applied Materials on very heavy volume back up close to this 58 level where I think we could get the right side of a neckline before another pullback. And that would set up pretty bullishly, I think, on a longer term chart. I don't know. Do you follow Applied Materials, Arthur? You have any thoughts on this one?
Yeah, it's one of the top semiconductor stocks. And I think if you look at that pattern that it formed there from October, that just looks like a correction after that high that we had. Mm-hmm. So it looks like, kind of like the market did in 2015. It just moved sideways slightly down for a couple months, and now it's breaking out and going to continue higher. So that looks like just a consolidation breakout happening.
Yep. Yeah, and this whole consolidation is really necessary. I mean, when you look down, for instance, at, say, the weekly RSI, I mean, when you get into a period where you're overbought, and I know you can stay overbought, and you've written some great articles about this, Arthur, where you look at Applied Materials, it became overbought on weekly RSI back here in January of 2017. Well, it made a 60% run in the next 4 or 5 months after it was overbought. So it's not like overbought means you sell. It's just certainly something you want to keep in mind, that at some point when you are overbought for a period of time, consolidation is a good thing, because it does start to unwind those overbought momentum oscillators. And especially if you combine that here with Applied Materials moving back and testing a key support level, I think that's a great sign, where you move intra-week below price support and then hold and move back to the upside. So anyhow, I think Applied Materials looks pretty interesting. But we did want to get into a couple of other things here, Arthur. I'm going to go ahead and point out a couple of stocks that reported earnings this morning. If you could, I'd like to get your thoughts. Maybe you can pull the charts up and take a look to see what these charts look like on your screen. But the first one is Home Depot. Home Depot reported earnings of $1.69 this morning. The market was only expecting $1.62. They also beat on their revenues, and they, I think, provided a pretty strong outlook. So I guess my question to you is, how does Home Depot look to you on a chart right now?
All right. So, Tom, you should see the Home Depot chart there now. Do you have it?
Yep, we got it.
Okay, good. Home Depot kind of looks like what we see with the stock market. And in that we're talking of the S&P 500, where you had this just really sharp advance, and it accelerated here, and then we just got hit really, really hard, and now we're kind of bouncing around in a volatile fashion. So the trend is definitely still up, but it's almost like the prize fighter that's been knocked out and sent to the floor, and is trying to stand up and gather his balance to continue on fighting. And I'm not sure if Home Depot's fully done that yet. It may need to come down and test this support zone into that 165 area before it finally settles down.
Yeah, and I think, too, a lot of times you get these stocks that make the big move. You can see Home Depot in November, December, and January. I mean, it was almost a straight-up move. And so off of that, a lot of times you will see these continuation patterns develop. This could be a bullish wedge that maybe eventually unfolds, where maybe that next low could put in, the bottom of a potential wedge pattern, and ultimately we get the breakout. But I agree with this one, went so far so fast that it is like the overall market been pulling back and may need a little bit more time to kind of gather itself before it has a shot at making another push to the upside. I'm going to give you another one. Walmart reported earnings this morning. They actually missed. And this one surprised me, because the broadline retailers have been doing extremely well. And Walmart came out with earnings of $1.33 versus $1.36. And then also, I think, said that their online sales were less than expected. So what are you seeing here with this chart?
Well, I'm seeing a gap down, and it looks like a breakaway gap because it's coming right after a high, and there's not a long downtrend before this gap down. So it looks like it's a breakaway gap, and this one's going to need to come down maybe into the low 80s and stabilize before it might be of interest or find support. So Walmart looks like it has broken down to me with that gap.
Is there a certain level? I mean, I see it's testing kind of the support level or the gap level from back in November, the top of the gap. Do you think if it fails to hold this gap, that then at that point it would be more likely to go fill the next gap, which is down closer to 80?
Yeah, I'm looking at kind of this, broken resistance zone and this gap here. coming into the low 80s somewhere as a potential support area to watch. But then, be below its 200-day. 50-day would probably be testing the 200-day at that point. So, yeah, it's kind of like looking into the future is really hard to do. But if I look at this chart right now, it doesn't look good.
Okay. I'm just there were 4 downgrades this morning. I'm just going to pick a couple of them that we can go over kind of quickly. But one would be Rio Tinto. Just broke out a couple of days ago, late last week, and has come down quite a bit. It's down 2% today with today's downgrade. Do you see this as an opportunity on Rio, or what do you think?
Well, this chart looks a little bit better, and I'll show you a little trick here. If you're not sure what Rio Tinto does, you can click that full quote box right there and click update again to refresh. And so you can see what they're doing, materials and general mining. And I think they're also quite involved in steel. And the steel ETF is at a 50 or near a 52-week high. So it really performed well. So steel is kind of a hot area right now. Rio Tinto is a foreign stock, so there is a bit of a currency conversion going on there. But I still think it's constructive in that, the trend is definitely up. It's still above this 50-day EMA. So I would expect support to be found here in the 52, 54 area, despite the downgrade.
Yeah, so if you like a stock, and I'm not saying that Rio you would be buying, but if this were the type of stock that you would get into, what's your strategy of getting in? Do you like to try to get in a couple of different levels as it heads down toward your key support? Do you hold?
I would look for something less volatile, personally.
Okay.
I would wait for it to calm down.
Okay.
Because, it's had this dip here and this surge here, and now it's pulling back. So, I'm more into the look for a bit of a volatility contraction as an opportunity rather than a volatility expansion.
All right. One more, and then we're going to move into the state of the market. Let's take a look at Snap. SNAP. Of course, this is a stock that, got a lot of press when they came public and really struggled for a while. But recently, 2 weeks ago, came out with a very nice earnings report. And you can see that huge gap up. You don't have the volume on your chart there per day, but I can tell you the volume was off the charts. It was almost 250 million shares, which is way, way, way above their average volume. And we saw that big gap up. Do you think this is a change in character in the chart?
Well, Tom, I know exactly why Snap's earnings are up. It's because I started using Snapchat over the holidays.
Well, I haven't used it yet, so they've still got more potential.
I know this is very, for somebody of my age to be using Snapchat is very weird, but when it comes to your children, you need to find a way to communicate with them. You need to go on their means of communication. And so I got onto Snapchat, and now we trade snaps once or twice a week. It's not every day. But looking at this chart, look, you got a nice base, and then you got this big gap and breakout. So I think this is a bullish chart here longer term. And this broken resistance zone is going to turn into a support zone. So if you get a throwback to this area, that could be an opportunity. Otherwise, maybe you've got some sort of a consolidation after this big surge, like a pennant or a flag, as you rest after that big move and look for the continuation higher.
Maybe off of those tops even, and some sort of like a symmetrical triangle might be forming, something along those lines.
Yeah, like a little pennant.
Yep.
Yeah.
Okay, cool. All right, well, I do know we're going to move on to our next segment. We're going to get into state of the market, and this is interesting, and everybody's got their own opinions. And so, what do you make? Everybody comes on here. I'm interrogating them now because I'm trying to get more and more great information from people I have a lot of respect for, and you fit right into that camp, Arthur.
Thank you.
What do you make of all the selling that's taken place? We had a market that at the end of January, everyone was saying, well, it's just not pulling back. We had great fundamental news coming out. You had companies like JP Morgan saying they were going to make a $20 billion investment and that they were going to raise their pay of their employees and paying bonuses, and Starbucks came out with a similar announcement. Home Depot, the tax reform bill went through, and that's supposed to be great for these corporate, these companies going forward. did we just get to the point where it was a buy on rumor, sell on news? And after all the great earnings came out, what are your thoughts? I mean, go through and I guess explain to the listeners how Arthur Hill is approaching what's taken place over the past couple of weeks, 2-3 weeks, and where you see things going from here.
Okay, well, the biggest concern that I see right now is we've basically gone from dull to volatile. And I have found that the best markets are dull markets as far as being bullish. There's an old Wall Street saying called never short a dull market. And in my commentary today, I kind of turned that around. You could also maybe invert that and say, don't go long a volatile market. And I kind of take that opinion. I'm not a bear. I'm not long-term bearish. I don't think we've entered a bear market yet. My indicators have yet to totally flip. But I try to set up some indicators to let these indicators tell me what the market is doing instead of try to make it a little bit more objective instead of subjective, take some of the guesswork out of it. Mm-hmm. It's still an opinion, so it's still prone to be wrong. But looking at this change in volatility that we had, you had a 90-day stretch here in the S&P 500 where you didn't have a move that was greater than plus 1% or less than minus 1%. It was actually not even less than 0.5% there. It was a very dull advance for 90 days, but we moved up like 15%. So that was a nice dull market. And then things kind of started slowly heating up. You had a move that was greater than 1% up. And then a few days later, a move that was greater than 1% down. And then all hell broke loose because you had 3.5% plus declines, and then 4 or 5 1+% advances. So things are getting chaotic. And that to me is a sign that says, whoa, back off. It's maybe a time to keep the powder dry and wait for things to settle down and pick a duller moment in the market to get back in. Now, as far as being outright bullish or bearish, I'm using my breadth indicators and I'm letting the market make the call for me. And these breadth indicators are based on the S&P 500, the S&P 400 mid cap, and the S&P 600 small cap. And what I do is I have 3 indicators for each index. And so that's 3 indicators, 3 indexes, that's 9 indicators. And so you get 5 of 9 can be bullish, and that's net bullish. And in January, all 9 were bullish. And these indicators have been bullish since the early part of 2016. So this first group is the 10-day EMA of advanced decline percent. So you have advances less declines divided by total issues for each of these 3 indexes. And when you get this surge above 30% in 2 of the 3, as we did in early March 2016, that is a bullish breadth thrust. You've got enough buying power out there to get liftoff and support an extended move. And the S&P 500 followed through a little bit later, and that's why I use all 3 and look for 2 of the 3 to trigger. So they were bullish for a long time until early February when all 3 plunged below minus 30%. So that tells me we've had extraordinary selling pressure, a downward breadth thrust. And that means that I need to pull back a little bit, keep some powder dry, and wait for things to settle down because these are bearish signals. Now, the next 3 are high-low percent indicators. And it's the same principle in that you have new highs minus new lows divided by total issues. And this is just a straight-up histogram. And you can see when high-low percent moves above plus 10%, that's bullish. And it did for mid caps and large caps back in March 2016. And small caps followed in June. So all 3 were in bull mode in June 2016. And you had some periods of weakness marked by the red, and I'll go over those in a second here. And then we got the downdraft in February, and mid caps had the bearish signal with the move below minus 10%. But large caps here held above minus 10%. So that means the expansion in new lows was strong, but wasn't quite strong enough to trigger that bearish signal. And the same with small caps here. Almost got below minus 10%, but didn't. So only one of the three indicators here triggered. Now, as far as these red zones are concerned, these are corrections in the S&P 500. And so you can see from August to early November, and then from mid-December to the middle part of January, and then in March, April. And these are corrections that lasted 4 weeks or longer. And then we had the August into early September, kind of moving flat in these last three. But if you look at high-low percent for the S&P 500, it did not get above plus 10% during these corrections. All four times. And so now that we've had this downdraft, I need to see high-low percent get above plus 10% to tell me that enough stocks have regained their footing and are starting to lead again and have enough to keep the market going higher. And I haven't seen that yet. So because 4 of my 9 indicators are bearish now, that leads me to believe we're in a correction, because that many shouldn't be on bear signals during a normal bull market or a normal uptrend. Now, the other 3 indicators are the percentage of stocks above the 200-day EMA. And this indicator is a bit of a laggard, excuse me. But you can see here, I have a bullish and bearish threshold that is just above the 50% line, which is the middle line there. So to get bullish, you need to move above 60%, because that shows enough critical mass as far as the number of stocks in an uptrend to support a bull market. And I stay bullish until it moves below 40%. So you can have dips below 50% here, but that's not enough. If you use 50% for your signal line, you're going to get a lot of whipsaws. It's kind of similar with the PPO. You know, if you're looking for crosses of the zero line, you can get whipsaws. So you probably need to put your bullish signal a little bit above zero, your bearish signal a little bit below zero to try and reduce the number of whipsaws. So these indicators triggered 2 of the 3 in March, mid-March, for large caps and mid caps. Small caps followed in April. And even small caps did not trigger a bearish signal throughout this bull run here. All right, and mid caps didn't either. They all remain on a bull signal, and I would need 2 of the 3 to move below 40% to push us into a bear market. All right, so that hasn't happened yet. And you can just look at these numbers here, and you can see 60% of small caps are above the 200-day. 62.75% of mid caps are above the 200-day, and 71.6% of large caps. So once again, large caps are leading and small caps are lagging as far as these breadth indicators are concerned. So when I look at that and I kind of, take the consensus view on what the weight of the evidence is, I have 4 of 9 indicators bearish. And so that tells me that we're in some sort of a correction, and that tells me to be on the sidelines until this correction clears. And then one more chart on the state of the market is the bounce that we're having now. So there it is from the 9th of February until last week, and now we pull back a little bit. But I'm using a Roth regression channel. And the reason I'm doing that is because if I put trend lines, I think they would be too steep. I don't think that would be a robust trend line there if you're drawing a trend line that steep. So the Roth regression channel is made up of 3 lines. The middle line is a linear regression, and I start it from the low, the closing low of the move, and I do it to the closing high of the move, like you see there. And the outer lines are equidistant, and the distance depends on the furthest high or low, and that's the furthest low right there. So as long as we hold 266.5, I think this short-term upswing is in play. And you have to have a slightly bullish bias, even though I'm in the correction camp longer term. But if we break down here, then I think we're going for a test of the February low, maybe a test of the 200-day. And as I'll show later on the Fibonacci retracements, a lower possible target if we break down. So I think I'll turn it back over to Tom.
Okay. Well, first of all, I completely agree with a couple of things that you talked about. I mean, one in particular was, that you like boring action. I mean, that's what I always talk about. For me, it's very difficult to manage risk in a market where the volatility index shoots up into the 40s and near 50. I mean, we saw what happened, the swings in the market. I mean, I'm trying to manage risk and protect my portfolio. How can you do that when the market literally from hour to hour is going up or down 800 or 900 points on the Dow? I mean, you just can't. So I love a boring market. That's exactly what I want to see. But let me go ahead. I'm just going to pull up one chart. I think I can probably get what I want from this one chart. And so let's take a look. I'm going to share my screen. Bear with me.
By the way, anybody that's looking for those breadth charts I showed can find them in the weekly market review and outlook in the members section.
All right, let's take a look. First, I have on the top the PPO. Now, I know everyone's looking at that huge move. This is a weekly chart on the S&P 500 right here that goes back 15 years. So it goes back really before the last bear market. So here was the last bear market that we saw, 2007 to 2009. Here's the bull market that we're currently in. And I think when you look at this long term, I think it gives you a little bit more perspective. I mean, every time we see selling, you get a lot of folks who are very, very, maybe perpetually bearish, always want to come out and say this is the start of a bear market. I think it's way early, number one, to talk about it being the start of a bear market. I think that the market deserved a correction and a pause. It got one. Let's see what happens from this level. Now, there's been a lot of talk about, hey, the market went up so fast, over the past year that it can't possibly continue at that rate. I would argue, and one of the reasons why I switched from the MACD to the PPO is I think the PPO does a much better job than the MACD when you're comparing overbought conditions over a long period of time, like I'm looking at here, 15 years, or if you want to compare momentum between equities or between sectors or indices. The MACD, because you have different scales of price, the MACD is only looking at the difference in price. So when you start pulling up a MACD, I think it can be very misleading when you're trying to use it to compare different periods or different stocks. The PPO, on the other hand, is using the percentage difference. So when we look back at where we were at the end of January, you can see that the PPO had gotten up to about 3.5, which means that the 20-week moving average, exponential moving average, was about 3.5% above the, or did I say 20? I meant 12. 12-week EMA is about 3.5% above the 26-week EMA. So when you look back, and yes, that was the highest we've seen in a few years, but when you look back at, say, the move that we saw back in 2009, of course, that was coming right off of the bottom, but we were well over 4% then. Even the move in 2010, 2011 went up to 4%, but the recent highs that we saw here on the PPO do mirror what we saw in 2012 and 2013 on these moves to the upside. I'm a big fan of the 20-period moving average, no matter what chart I'm looking at. So if I'm looking at a weekly, I like the 20-week EMA. If I'm looking at a daily chart, I like the 20-day EMA. But you can see that back in 2012, 2013, 2014, and this is really what I liken the 2017 move to more than any other time frame on this chart, is 2013, 2014. We saw a lot of strength in many of the aggressive areas back then, just like we've been seeing, or like we saw in 2017. There just wasn't a whole lot of weakness back then. We did see periods of consolidation. Here was the XLI relative to the S&P 500, but other aggressive areas were breaking out and kind of holding the ship up. My big problem with calling this a bear market, I have several, but my biggest problem is that money on a relative basis continues pouring into technology, the industrials, the consumer discretionary group, and financials. Now, you might look back and say, well, we're way down from where we were. Well, we went through quite a bear market in financials where basically our financial system almost collapsed. I think it's important to note, looking just in the short term or even over the last couple of years, this group has been outperforming the S&P 500, and I find that to be bullish. Now,
yeah, and that's a new high in the price relative this year. So.
Yes, yep. And that doesn't make sense if we're heading into a bear market. These four groups would not be breaking out on a relative basis or be in uptrends. I think you would start seeing deterioration. In 2006 into 2007, when the S&P 500 was making its final highs before a bear market, you can see, number one, XLK was strengthening in 2007, but it had not broken out. It actually didn't break out until 2009 when the bear market ended. Industrials were still okay. I wouldn't argue there, but check out consumer discretionary making a breakdown. It was trading at multi-year lows here at the end of 2007 when the S&P 500 was still near its all-time high. The XLY on a relative basis was breaking to multi-year lows, as was the financial ETF. We're not seeing any of that in the market right now. There's no weakness in the aggressive areas as far as I'm concerned. And, once we got into the bear market, you can see particularly consumer staples relative to the S&P picking up and utilities picking up as we were going through that bear market. Check out what's going on now. Even with the weakness that we've seen, we're setting new lows on the XLP and on a relative basis, and we're setting new lows on utilities. I just don't see the money rotating the way it normally would if we were heading into a bear market. So this is really the only chart, and I think I also pulled up the VIX. I mean, obviously, we've got a lot of volatility, but it's not unusual to see the market get a little nervous during a period of selling like we saw. I mean, you mentioned it earlier, Arthur. We lost 10% in 10 days. That's going to scare a lot of folks. And it's not only going to scare folks, but if you know how the volatility index is calculated, it's looking at the premiums that are being priced into the S&P options over the next 1 to 2 months. So as the market is selling off and everyone's getting fearful, these options are being priced at much higher levels. So it's almost like a cat chasing its tail. Is it the selling that's triggering the VIX, or is it the VIX rising that's triggering more selling? I'm not quite sure, but it's not unusual to see the VIX, when it spikes, to print a very significant low in the market. We saw it back in 2015. And the last thing I want to say is I want to just make sure everybody is aware that Chart Watchers was out over the weekend. And so you want to check that out. And in the Chart Watchers article, my Chart Watchers article, I talked a little bit about the Fibonacci, and the fact that I compared what happened, with the VIX. I think I mentioned here the VIX, when it gets up into that 40-50 zone, it doesn't happen very often. Here was, going down memory lane. This is what we looked at on the S&P 500 back in 2015, where we had the big drop, the volatility shot up, we got a reaction high, and then we ended up going back down. And I know you mentioned this earlier, and I think this is kind of a common theme. I think a lot of folks are expecting that we're going to go back down maybe and test that recent low. That's what we did in 2015. And you can see volatility spiked. And by the way, this was just a little bit more than the 10% drop. And when we came back up, we had a false breakout above the 20-day moving average before printing a reversing candle right at a key Fibonacci retracement zone. And then we moved back to the downside. And then I compared that to what was going on in 2018, what we've seen so far. Here's that drop, a little bit more than 10%. Here's the rally back just above that 20-day EMA. We printed a shooting star candle, or actually inverted hammer. We didn't get a gap up, and I think that's required with a shooting star. But it's an inverted, no matter how you look at it, to me, it's a bearish-looking candle at a key Fibonacci retracement level. And look at the VIX shooting up to 50, very similar to what we saw here when it went back in August. So when you get this kind of selling, it's a panic sell-off. It marks a very significant bottom. And so I think how things go from here is really what we need to be looking at in terms of how we evaluate the market as we go forward. So just to conclude in this segment, I think it's fair to say that for me, I think that patience, I'm still bullish. I think patience is going to be rewarded. I think that we will ultimately see this bull market continue. I'm looking for some sort of continuation pattern to develop. But if you're looking, from my perspective, I think that you have to be patient and allow things to kind of set up. I moved 100% into cash on Friday. The move up late last week, there was a lot of rotation into defensive sectors on a relative basis. That bothered me. The VIX is back down to a key support level, in my opinion, of around, got back down to about 17, which during bear markets, the last two bear markets, we never actually went below 16 on the VIX during the entire, both bear markets. So I think as we see the VIX settle back down, if we see the VIX settle back down, I think that will get back to your point, Arthur, about more, boring action starting to come back into the market. And I think that would help things settle down. But Arthur, you think it's time to go fishing?
Well, I have to attribute that quote to Nick Raj. He's the chartist from Australia, and he said there's a time to be bullish, a time to be bearish, and a time to go fishing. But, Nick lives in Australia, so it's bloody easy to go fishing when you live in Australia. It's not so easy from Belgium.
Especially in February.
Yeah, it's in the middle of his summer.
Anyhow, well, I talked a little bit about the Fibonacci. I know you use the Fibonacci tool a ton. So I think what we'll do now is we'll move in, and maybe you can just illustrate, using the annotation tool. First, I guess show everyone what Fibonacci is. I guess it's not everybody is a Fibonacci follower, but maybe just talk a little bit about Fibonacci and how you use it and how you annotate. I think folks get a lot out of that.
Okay, I will do that. I've got a screen here. You should see setting correction targets for the S&P 500. And the next chart I'm going to show you is one that's already annotated. And I'm going to show you how I got to these annotations from scratch and when I would use the Fibonacci's and how I would use them to mark a potential support zone. And potential is the key word here, because, this is a little bit art, or a lot of art in my case, and a little bit of science. So if we look at this chart here, and before I get into Fibonacci's, the Fibonacci numbers are based on the golden ratio. And if you just Google Fibonacci ratio, you can read all about it. But basically, you have a 38.2% retracement and you have a 61.8% retracement. There's also retracements that were advocated by Charles Dow, and those were 1/3 and 2/3. And in between 1/3 and 2/3, you have 50%, and in between 38.2% and 61.8, you basically have 50%. So Dow and Fibonacci were not that far apart. 38% is fairly close to 1/3, and 61.8% is fairly close to 2/3. Yeah, I know we're talking about hand grenades, but they are pretty close. And so when you get into that 50% area on a retracement, you want to be on alert for a potential support area, for a potential reversal, and a potential continuation of the trend. Because basically what Charles Dow is assuming is when you have a big move up, it's natural to have a move down to retrace a portion of that prior move. So if you make 2 steps up and 1 step backwards, that's a 50% retracement. So that's where that comes from. So Fibonacci or Dow, it really doesn't matter. Basically 1/3 to 2/3 is the area you're looking at. And that's when you want to go on high alert. So how did I get to those retracements? Well, as far as I'm concerned, I think the last bull run began here in February 2016. Because if you go back to July, August, December, January of the previous year, you'll see that we had about a 6 to 9 month decline. And that didn't look like a bull market to me. And breadth indicators turned bearish during that time. We had some whipsaws as well. But here's when the bull run started. And it's been a massive bull run. So that's the first place I would start my Fibonacci retracements. So we'll start from this February low, and I'm going to go all the way up to the January high. with these retracements. And you can see I've got the percentage and I've got the number. Now, the next place I'm going to look at is the next correction that we had. And here's the Brexit low. So I'm going to go ahead and draw another Fibonacci retracement from there. And I'll color it red so we can distinguish it a little bit. And actually, to make it a little bit easier, I'm going to move this one over. And I'll make it a dark green. All right, so this was the Brexit low correction. And then the next place I want to draw the Fibonacci would be after this correction we had here in August, September, and October. And then right before the election, we bottomed there. So I'll draw another Fibonacci retracement from this low. Whoops, I've got some crazy drawing going on there. Let me try that again. Still going a little bit crazy, but I think I can flip it. All right, so now I have 3 Fibonacci retracements on this chart. And at this point, what I'm going to do is I'm going to look for some clusters. All right, see where they come together. And I'm also going to look for some other places that might be support. Because you can see here, you have kind of a consolidation there. And we have a consolidation in this zone as well. And then when we look at the first Fibonacci retracement, after the big run from February to January, a 2-year run basically, that's 38% retracement. That's the first natural area. And then we can see from the Brexit low to the high, we have a 50% retracement coming in that area as well. And then on the blue Fibonacci retracement, we can see a 50% and a 62% coming in that area. So basically now I've got 3 Fibonacci retracements and I've got a consolidation here. So if I combine all these, I've kind of got a zone to work with. And I'll go ahead and color that into gray so you can see it. So this is kind of a way to estimate a potential support level if we have kind of A, B, C. If we have another leg down and we break below this low, where might we find support? Well, I'd be looking in this 2400 to 2500 area based on these Fibonacci retracements and this consolidation you see here from June, July, August of 2017. You can also put a moving average on there if you want. As far as moving averages are concerned, I think so many people watch the S&P 500 and so many people watch the 200-day. I think that's just a natural place to look as well. So I would always keep the 200-day SMA on the S&P 500 chart. If for nothing else, it is a self-fulfilling prophecy if enough people are watching it. So there you can see. So if we get another test of the low, it's going to be back to the 200-day. But if we break the 200-day, then down to that 2400, 2460 area possibly. So how does that look, Tom?
It looks awesome. I mean, I do think, well, first of all, I think it's awesome to compare the different Fibonacci zones and to find a cluster, because I think, you know, you're trying to put as many technical facts together as you possibly can to come up with a, you know, a potential support zone. I think another thing would be maybe looking at a long-term trend line, you know, on a weekly chart. And if that happens to come in somewhere close to these clusters, I mean, I think, you know, it's kind of putting everything together. And, you know, the more technical clues that suggest that a key support zone is being reached, I think the better off you are in making a call where maybe you would think about going long the market on a pullback, or, you know, for me, where I might consider moving more, you know, becoming more aggressive on a pullback. I'm thinking that we're going to have some kind of a continuation pattern. I could see maybe a bull wedge or some kind of triangle forming. We had such a big run up off of the August low on the S&P that I still think we could make that. We might go down and and possibly take out that low that we saw, and maybe move into that 2,500 area, which is the top of that cluster that you're showing. So I think it's a great depiction and illustration of how you can use the Fibonacci tool to set this up and project some possible support areas.
Since you mentioned that August low, I've just you can see we bounced right at that 62% retracement from that August low to this high. So sometimes you have to ask yourself, what is the last thing you expect in the market? And if you say we're moving to new highs in 2 weeks, then you better be prepared for that.
Yep, no doubt. So I guess to summarize, before we get into the 10 in 10, I think you went through it, but basically, retracing when to use them. I think you picked some great levels to try to get that cluster. You spoke about both the Dow and Fibonacci kind of being cousins and how they approached these retracements. And then we just talked about corroborating evidence, looking at trend lines, looking at price support and some other areas to help corroborate what Fibonacci is telling us. Because to me, and I don't know if you agree with this or not, Arthur, but to me, the most important thing in the stock market is price and volume. Everything else is more corroborating what I'm seeing in terms of price and that combination of price volume. But is that similar to what you see, or is there something that you find is more important?
No, I just use price pretty much. I don't use volume very much. Okay. But as far as the broader market is concerned, breadth and price would be my two things. But yeah, price is the ultimate arbiter. No doubt about it.
Yeah, no doubt. I agree with you. Okay, well, let's go ahead and move on to the 10 in 10. I tell you what we're going to do. We're going to do a little treat today. I'm going to go ahead and annotate 5 charts, and I'm going to turn it over to Arthur, and I'm going to let him annotate 5. And I don't know if we can do 10 in 10, but we're going to try. I've already annotated the first one for today, which is AMD. So here is kind of what I'm looking at on AMD. Now, I do use this, the tool, the price volume tool, or not price volume, but the price support resistance line. I use that more than anything because, again, to me, it gets down more to price support and price resistance than it does anything else on the chart. But AMD gapped up on really heavy volume in January. We've gone back down. We filled this gap. So I'm looking at this gap support zone between 11 and 1150. And then, of course, we had recent highs at the end of January, 1375. And 14 and a quarter is the high that we saw back in October. So that would be a resistance zone that I'd be looking for. I think the space itself is very strong, as I mentioned earlier. Semiconductors doing extremely well. So I'm a fan of AMD. It's just a matter of trying to make sure I can get it at an area where I can keep my stops fairly tight. So that was the first one. Now, the second one that I had was DIN. And I just got all of these symbols, by the way, from the chat room today. DIN, Dine Equity, huge move today. I'm assuming this is earnings related. I think if it was a buyout, it would just be a huge move up, a gap up. But something has come out on the stock today, clearly with the volume just off the charts. Let's see if we can see any overhead resistance going back weekly. Yes, we definitely can, and we're just about there. So I think on the weekly chart, while the daily chart looked like it was blue skies ahead, the weekly chart, I think, tells you something a little bit different. You had a couple of key lows that came in between about 67.5 and 70. Today's high is 67.75. If I was in this stock and I got this kind of move looking at the long-term chart, I think I would be taking the money and running, especially a 23% move today. And let's see if we can get through these key resistance levels. The good news, though, is the volume is very strong. So if we can make this breakout with that kind of volume, I think it would be a bullish development. So let's annotate, put this one away. 3 more, and then I'm going to turn it over to Arthur. Next one is Lazy Boy LZB. And I'll stick with the weekly chart here because I think, first of all, what this is telling me is that over the last year and a half, this stock's gone nowhere. I mean, it was in August, in the summer of 2016, it was trading at about 29 bucks. And right now we're trading at 29.15. Market has gone straight up. So right away, you've got a stock that's not outperforming. It is badly lagging over the last couple of years. So it's probably a stock I'm not even going to consider. I think to the upside, you've got some resistance, 33 to 34. really the key areas of support, probably are down 22, 23, the most recent lows. And I'm sitting in the middle. For me, it's not a trade. I would not be in this one. I'd just move on looking for another possible candidate. Last two here, CP.TO for our Canadian friends. Let's take a look at Canadian Pacific Railway. Now, this is consolidating here above price resistance. I like the sideways consolidation. So it's one that I think is preparing for a more likely than not breakout to the upside. Here was the sideways consolidation. You can see a couple of different support areas. But you can see when we made a breakout on some good volume back in July of 2016, we kept going higher, but notice these pullbacks were always contained between about 185, 190, which I think was great support. We finally made this push up, took out the high in May of 2017. And when we did it, look at the volume expand on this move and check out where we have been holding as support. Broken resistance becomes price support. Broken price resistance becomes price support. That's TA 101. And recent highs up here around 235. I think we're in a trading range. Again, will we go back down one more time here to 215? Well, if the market overall is weak, maybe we do. I would not be a buyer at the top of this resistance. I think that the short-term risks are more to the downside until we get this breakout. So I'd be holding off on CP, but I do think that this is a bullish chart, and eventually I'm expecting a breakout off of this stair-stepping pattern of higher highs and higher lows. So let's annotate or save this annotation. And one more, and then I'm going to challenge Arthur. Last one for me is TDOC. I'm going to go back to a daily chart. And TDOC is making a nice breakout, and the volume is picking up. It's not. It's already higher than it was on Friday, and it's probably at the pace it's going to be higher than anything we've seen probably in February, or certainly close to it. So I like the combination of what's going on here. I don't know if there's news out on Teledoc, but here is your resistance level. We have not had a close above 37.50, and we are making a big breakout after months of consolidation. I find this to be very bullish. PPO is rising, so prices are accelerating. Price action is accelerating to the upside. We're not even overbought yet. I'm not normally one to buy on a breakout. I normally buy on a pullback. But if I was buying on a breakout, this would be one that I would be looking at. I think this is a really nice looking chart, assuming that it holds into the close today. Now, if it leaves a long tail to the upside, you can see what happens when we get these false breakouts. We then see weakness coming up after that. So I think the key for me on TDOC is whether or not we hold this into the close. And with that, I am going to turn it over to Arthur. And your first stock, Arthur, is going to be FXI.
Okay, let me grab that.
Yeah, I've got a few here for you, but the first one is FXI. So I think it's a good exercise to see how you go through and annotate these charts. I mean, if this is one that, or just assume these are stocks that you're interested in, what annotations would you use and, in saving it for future reference?
Okay. There's U.S. Steel, by the way. Hint, hint.
Someone asked about that in the chat room, by the way. I didn't have it on the list for the 10 and 10, but there was.
What else do we have here? Oh, we got Google too. Okay, here's the China large cap ETF. And I'm going to do what Tom did here and back some of these out to a weekly chart to try and get some perspective here. But, China was definitely in the leaderboard here when it was advancing from lost my date here, from December 2016 all the way into January 2018. And like everybody else, it had this big surge and kind of got extended. But the way I see it is, you got a big consolidation here in that 46 area that I think marks support, and we're pulling back to that area. So we've firmed and we've gotten our initial bounce. I'm not sure if this bounce is going to hold. I would probably turn to the daily chart to see, but this is the area to watch for support. If we get back into this area and the S&P tests its 200-day and you start to see things turn around, then that would be a good place to look to pick up FXI. And if you look at RSI,
no, I was just going to say it also looks like, when we're talking about corroborating evidence, I think if you start on the left side of the chart, you got a little trend line there that seems to maybe be coming up very close to that, that support zone. Yeah, right in there. I think if so as we go out in time, that trend line is going to continue rising, and it's moving, faster and faster up toward that price support zone. And so that's, again, give you another technical reason why you could see some buying in that area.
Yeah, and this other trend line is coming in there too. So,
all right, got a second one here for you, and you mentioned Google. How about Google or Alphabet? I can't call it Alphabet. I have to keep calling it out Google.
I cannot get my head around that either. I still call it Google. So, but when the chart pops up and I see the name up at the upper left-hand corner, I'll say it, Alphabet. Okay, so, Alphabet almost looks kind of like everything else in that big move up, September into January, and then a gap down. It's bouncing off this 200-day EMA. And more importantly, you can see, or talking about corroborating evidence, here we kind of have a resistance zone, and I'll go ahead and color that red since it's resistance. And then it turns into a support zone. And you can color that green to make it support. And I bet you if you put on some Fibonacci's, in hindsight, wonderful. So we look here and we can see we got a nice reversal off the 62% and right off that 200-day and this support zone here. So Google's above its 50-day. And so it's keeping up with the market, if not outperforming over the last 7 days or so. QQQ is one of the leaders as well. And Tom was noting that semiconductors are perking up. So it looks like technology is still the place to be. So, if you're going to be in this market, I think Google is a place to look at because of its leadership.
Yep. Okay. Let's see. There's a semiconductor that someone was mentioning, MSCC. MSCC.
MSCC. Microsemi. Yeah, look at that nice base that they built and then broke out. It's kind of looking like a rounded bottom. I'll use this parabola tool here, and you can make 3 points there, and I can make a thick line and color it green. So this is kind of a rounding bottom, if you will. And then we had a resistance zone. Whoops, looks like I'm going crazy on my drawing there. I'm going to switch to the rectangle now. But look at this big base, and then big breakout, and then a throwback towards the breakout zone held just above it and turning back up. 50-day EMA is above the 200-day, so I would say that this chart looks bullish, and you have an even smaller breakout right here, and I think that's the level that needs to hold. So if you go back below 59, then you have to be concerned.
Mm-hmm. Excellent. 2 more to go. Let's do Overstock, OSTK.
Okay. Let that save. OSTK. So this one, man, what a moonshot. What did they changed a blockchain or something? Is that what happened?
I think there was something with that. It's not one that I follow too closely fundamentally, but I do know they were in the news a lot, and I think it may have been blockchain or something.
Yeah, so I clicked this inspect button up here at the top because I want to just do a quick measurement here. So I'll go from the bottom and I'll click and I'll hold that and I'll drag it up to the high. And if you follow this blue line to the left, you can see up 440%. Wow. So that would not pass any of my volatility screens. Maybe if I was in my 20s, I would be interested in this, but unfortunately I'm not. Might be something for my son in the future. But the first thing I notice is this gap here. And as long as that gap holds, maybe you got a bullish case and you're above this 50-day EMA. Because, it did hit a 52-week high here. It's above the 200-day. So if you move back below 60, then you got to be concerned, because then we can put a line here and draw what could be a little rising wedge. And we'll get out our old buddy, we'll call them the Dow retracements here. We're up into that 50% retracement. So if you break below 60, it looks like Overstock is going to move down into the mid 40s, maybe the low 40s.
Clearly, it is a volatile stock, so anyone in it needs to recognize what they're buying.
Definitely.
Okay, last one, SU. Suncor, SU.
SU. I think I should call in Greg Schnell for this one.
He'd love it.
Absolutely. You know, the oil and gas area, and I don't know, maybe Suncor is an individual case because I think, are they into the tar sands thing?
I'm not sure. Yeah, I'm not sure.
Greg, where are you? He's not listening, is he? He doesn't watch our show. So look at Suncor here. You know, I don't know if that's a 52-week high, but that's a multi-month high there that it recorded. And it's come back to this kind of resistance, turn support. Yeah, it broke this low, but, you know, I'm kind of I use zones pretty much. So it looks like we're bouncing off of a zone here. And if it can get back above the 50-day, it might have a chance to make a new high. But I would watch oil as well, because this bounce is probably tied to oil. And I think oil has been up the last 4 days. So as long as oil continues its bounce, I would expect Suncor to follow. And then one more thing, you can see RSI oversold for maybe a week and then moving out of oversold territory. So, you know, it's turning up, but it hasn't quite got the breakout yet.
Mm-hmm. All right, so one to keep on your radar for sure if you're interested in Suncor. Okay, and that is the 10 in 10. We are going to have those in the Market Watchers live blog later today. We'll ask Arthur to get those annotated charts over, and I'll have mine as well. So that should be in the blog later today if you want to take a look. And there are the 10 symbols that we took a look at. So with that, let's take a look at something that's coming up in August, and it is ChartCon. And
ChartCon.
I know you're going to be there. I'm getting very, very excited about this. I have such a great time getting together with everybody. Go ahead.
I wish it was next week.
Well, I don't know, because we're going to Alaska. I don't think I want to go to Alaska in February.
Oh, okay. Well, that's true.
Let's hold off to August for that. I'm a golfer. You know, I can't go to Alaska in February. That's not happening. But I do want to take everyone to the page where you can sign up. It is, registration is open. So first, let me get over to the screen here. Okay, so from the home page, or really all you have to do is type in stockcharts.com/ChartCon, and that will bring you to the page. This is a page dedicated to this event. It's held every couple of years. Just an unbelievable group. I mean, I feel so privileged and honored just to be in the same space with a lot of these folks that are really the titans of technical analysis. I mean, when you look down the list of who is going to be speaking, and by the way, this is an online conference. You can elect to come out and join us in Seattle, and then even take the cruise with us up to Alaska. But 99% of the people joining us are going to be joining us online. So you can literally sit in your living room or your table, kitchen table, or on your bed with your laptop, however you want to watch it. But for 2 days, you're going to get some awesome technical analysis information. This particular ChartCon is really based on risk and how we deal with risk. Because, if you're trading the market and you're not thinking about risk, you're probably doing something very wrong from the beginning. I mean, every strategy that you have in the stock market should be based somehow on managing risk. And so when you look down at the title of all these presentations, there's Greg with his minimizing risk with tight stops and horizons. I mean, we can go down the list, but you and I earlier today Arthur, we were talking about the volatility index, and you can see Dr. Alexander Elder using market volatility for placing stops and reducing risk. But you can get a sense as you go through all of these presentations, and there yours is, Arthur, proven techniques to reduce portfolio drawdowns. I mean, very timely when we talk about risk. But go through all of these, and it is going to be an amazing ChartCon. I think it's going to be the best one ever. And so just make sure that, you go to the page, take a look, and you can just click on the button, the green button to register now and save your spot for ChartCon. Really excited about it. And
indeed, it's going to be a good event. Great event.
Yeah, and it's hard to say, what's going to come out when Greg Schnell is in the room. He is one of the funniest guys. I mean, he really and truly is. He makes me laugh so much. But anyhow, there'll be a lot of fun out there. And then also, of course, we never can get away from the stock market. So we're always talking about the stock market as well. But should be a great time. If you can join us online, great. If you could make the trip out there, it'll be the trip of a lifetime. Especially, I've never been on a cruise, number one. I've never been to Alaska, number two. So I'm really looking forward to it.
It's a bucket list.
It really is. Okay, let's take a quick look at the market, and then we're going to get into our agree or disagree. And the way I look at the market is basically the candle glance. I mean, if you want to get a quick, dirty a look at what's going on in the market, just click on this candle glance, and there you go. I think it's Erin that likes to take out the Wilshire, and she likes to sub the TSX in here for our Canadian friends. And so here you go. You got the Dow right now still down. Well, actually, it's moved back down a little bit, 147. S&P's now moved back into red territory. NASDAQ continues to perform really well. And as I mentioned earlier, the technology group doing well with semiconductors bouncing. That certainly is helping. Russell 2000's moved back in the negative territory, trying to get through a couple of key moving averages. The TSX, you can see, is lagging on a relative basis, not able to get back up to these moving averages just yet. Has bounced off of the lows, but not performing very well on a relative basis. 10-year Treasury yield continues up just above that 290 level. The dollar starting to bounce. And I tell you, I've got an interesting chart, and I'd love to be able to pull it up later, Arthur, and have you look at it and tell me what you think. If we get to it, maybe I'll try to do that in the last couple minutes of the show. DBC, which is commodities, you can see a nice bounce here over the last 6 days or so, but also off of its high from earlier today. The U.S. oil fund rising, but it too is coming back down off of its earlier high. Gold weak, the volatility index rising. I think it was up maybe 2.25% last time we looked. Now it's up 3.5%. So we got volatility starting to turn back up again. I'm a little nervous about the market here.
Yeah, 20.14.
Yep, 20 back over 20. And I know last time we had you on the show, you were watching that 20 level. We dipped just a little bit below, but now we're back up above it. So as you mentioned, I think that, going fishing is certainly one option right now, no doubt. And you can see the NYAD weak, as you might expect, with the market lower today. And so let's get into the agree or disagree. And I'm going to let you go first, Arthur. But basically the statement is gold going to outperform, or actually not is gold, it's not a question, it's a statement. Gold will outperform the S&P 500 over the next 12 months. Agree or disagree? Give me your thoughts.
I would say disagree. And to do that, I will pull up, guess what, a few charts.
Do it.
So let's get these charts up here. Of course, when you talk about gold, you always think about the dollar. And I think the dollar may be poised to bounce here. I'm going to go ahead and go to that next chart. I try to analyze the dollar once a month because I find I should do that with gold as well, because I find gold and the dollar kind of frustrating. But one thing I'm noticing is the yield differentials between the U.S. and Europe and the U.S. and Japan. And the fact is that U.S. yields are rising faster than yields are in Europe and in Japan. So I've got the dollar here, and I've got the differential between the U.S. 10-year and the German 10-year, and the differential between the U.S. 10-year and the Japanese 10-year yield. And you can see here that When that differential rose, U.S. yields rose faster relative to European yields. The dollar moved higher. And the dollar is 57%. The dollar index is 57% euro. So that's the main thing to watch here. And then you can see this yield differential was flat and the dollar was pretty much flat. And then we had a decline in the yield differential and the dollar declined. And then something kind of happened here because the yield differential moved higher from September to now, but the dollar moved lower. So there's been a bit of a disconnect. But the fact that these yield differentials are moving higher and U.S. yields are moving higher may put in a bottom for the dollar. So you might watch for a little breakout here. And if that happens, of course, I think that's going to weigh on gold. So the next title slide would be marking key support for gold. And as far as gold is concerned, okay, it's in an uptrend. And that's silver, by the way, in a downtrend. So they're clearly not on the same page. But gold has this wedge breakout working. And it's got a smaller wedge and a breakout, but looks like an inside day forming. This is a weekly candle, though. So a bit of indecision. And if gold breaks down here, I think we're going to be heading lower for gold. And of course, you got to watch the dollar. But I think the next chart is the one that really answers the question on will gold outperform the S&P 500. And being a guy that kind of follows the trend and takes the chart for what it is and try not to read too much into what it will be, you know, there's clearly a downtrend here in the gold S&P 500 ratio. All right, it peaked here in 2011 and has been moving down ever since. And it needs to break out here to reverse that relative performance downtrend. That's a long-term downtrend in relative performance. And until that happens, I would suggest that the trend continues and gold continues to underperform the stock market. And then the bottom indicator is the 52-week rate of change for this price relative. So the green areas show when the rate of change was positive and gold outperformed. And then the red areas show when gold underperformed the S&P 500. The rate of change was negative. So a little bit of positive in 2016, but has been negative for most of 2017 and into 2018. So that is the answer there.
All right. Well, I tell you what, I promise that Arthur and I did not share our charts before this started. But
we didn't. We didn't.
We didn't even
We're in different countries.
Yes. And I have almost identical charts to show. So I'm going to go through this really quickly, but I do have a couple comments that I'd be interested in your thoughts, Arthur. First, here is my chart, and it almost, I didn't have it versus the Treasury yields in Japan, but you can see I was comparing the U.S. 10-year Treasury yield versus the German 10-year Treasury yield, and I had the exact same chart. So this is going
okay.
last 10 years and seeing how this yield relative to Germany, U.S. yields are moving up, and the fact that the dollar is moving down, which I too had indicated was kind of a weird thing. And I even put a correlation indicator in here showing the relationship between the U.S. Treasury yields in Germany and comparing that to the dollar. And this is only the third time in the last 10 years that we have seen the correlation hit a negative 0.5. And I wanted to point out the last two times that this happened, because here you can see Treasury yields in the U.S. relative to Germany were going higher, and here you can see the dollar was going down. This is where you see the negative correlation. And what happened? The dollar quickly rallied to play catch up with what was going on on this chart. Second time it happened, again, we got the Treasury yields moving faster in the U.S. to the upside than in Germany. The dollar was, as a result, getting hit to the downside. Once again, we hit that minus 0.5. And what happens? The dollar plays major catch-up very quickly. And so now I'm looking at the same thing. It's like, as Yogi Berra would say, it's deja vu all over again. We got the 10-year Treasury yield moving up relative to Germany. We got the dollar moving down. And I think this is a major support level on the dollar index, by the way. We had a triple top breakout around 89, 88, 89. And you can see off of the lows in 2011 coming up. We're just about on that trend line, and here's that negative correlation again. So I completely disagree with the statement that gold is going to outperform the S&P 500. I don't see it at all. And in fact, this is the chart I wanted to show you that I was talking about, Arthur. I wanted to get your comments, because when we start to see outperformance, once the dollar starts moving up, what we have seen in the past is the Russell 2000 moving up much faster than the S&P 500. Both of these times when that dollar took off, you can see the Russell 2000 on a price relative chart to the S&P performing very well. And we're at a key price support level, price relative support level on the Russell 2000 as we compare it to the benchmark S&P 500. So, and it makes sense as well, because when the dollar's rising, of course, that's a headwind for the
multinationals. Yeah.
Yep. You got the multinationals, and they've been benefiting by this dollar that's been dropping for the last year, and we've been seeing this price relative go down. So I think we're at a really critical point with the dollar, and that could translate, if we're right and the dollar bounces, I think it could translate into some serious outperformance in small caps.
Well, it's true. The decline in the dollar has really helped buoy large caps over the last few months and put more money into large caps. So that's what small caps need. A, we need an end to this correction in the stock market, and B, an upturn in the dollar to help small caps.
Yep. And one last thing I'll just mention here, because it's really along the same lines. This was the other chart I swear I was going to show. But if we pull up gold relative to the S&P 500 on the same chart and compare it to the dollar, normally when the dollar is weakening, that's when we see outperformance. That's when the gold outperforms the S&P 500. But check out what has happened over the last 13 or 14 months. The dollar has been falling, which normally would mean gold should be performing really well. And even with a tumbling dollar from 103 down to 89, which is about a 14% drop in the dollar index.
It's a huge move.
It's a huge move, and gold can't outperform the S&P 500 with a massive drop in the dollar. So I can't get behind gold. And I've pointed to the same thing that you showed. This is part of my problem. I'm trying to outperform the benchmark S&P 500, and I don't think you can do it with gold right now, not until it shows me something.
Maybe we should have asked, will gold outperform the Russell 2000?
We don't have time for it now. We'll have to get that next show. Okay, so there's your agree or disagree. The live audience disagrees as well. So they also believe that the S&P 500 will do better over the next 12 months. So what this probably means is make sure you outweigh gold going forward. But anyway, we are getting close to the end of the show. I do want to ask you a question. This was a question that was in the chat room. Since we've got you here, I want to ask you: Do you use Wyckoff at all in your analysis?
It's almost like saying I definitely use principles of Wyckoff, but I don't use it to the letter like Bruce Fraser does. But there are principles in Wyckoff that are very solid as far as the trend is concerned. There are solid trend principles in Elliott Wave and Dow theory that are still valid today. So, I'm a pretty basic guy when it comes to the trend. So I do use some principles that are in Wyckoff, but I don't use it to the letter.
Okay, that's fair enough. Yeah, I hadn't really used Wyckoff much, but we've had Bruce on the show, and he was looking at a stock that I owned, and I had seen it was breaking down below price support, and I'm thinking, I might want to sell this. And Bruce made a very astute point. He said, well, it looks like a spring maybe could be setting up for, and I think it was GNRC, I think was the stock. And the stock did break just below support. And I was like, okay, I'm going to hold it for another couple of days and just kind of see. And he was correct. I mean, that thing shot back up and went up for the next several days. And I ended up making money on it after I would have been stopped out. So at that point, it's like, okay, I like Wyckoff now all of a sudden. I think it's too. But anyway.
I think Bruce has the best annotated charts out of any of us. His charts are so well done.
Mm-hmm. Yep, no doubt about it. I mean, well, first of all, I think there are a lot of great analysts at Stock Charts. Like I said earlier, with ChartCon, I feel just honored and privileged to even be writing in the same space with a lot of folks. I mean, I grew up mostly self-taught, but I followed a lot of John Murphy's work. And after I started here, I've said this multiple times, I think of all the people at Stock Charts, I think I probably think more closely, my thoughts and strategies are maybe more closely aligned with yours than anyone else, which is a huge compliment to me, not so much to you.
Oh, come on. We're the pullback players.
That's it. We're team pullback.
Yeah, we're team pullback.
But anyway, we do need to wrap up. This week, coming up on the show, we do have Greg Schnell. We were joking about Greg earlier in the show, but he's a great friend and really very sharp guy. Just published
Absolutely.
Yep, just published his book, so you want to check that out in the bookstore. But he'll be with us tomorrow. Everything Stock Charts on Thursday this week, and then Friday, I mentioned earlier, put it in the survey. Fill out that survey, lower right part of your screen. Click here. You just click on that. It's a very brief survey, but if there's a topic you'd like for me to cover on the workshop on Friday, I'd be happy to take a look and see if we can get some common interest there and try to find something. But another great show. I want to thank you, Arthur, for subbing for Aaron today. It was great having you on here.
My pleasure. Thanks for having me.
And by the way, Aaron will be back tomorrow. So for those of you who missed her today, she will be back tomorrow, back from Vegas. Hopefully we don't have to take up a collection bucket to help her out after this weekend, but we'll get some more on that tomorrow. I want to thank everybody for joining us today. Please remember to complete that survey I mentioned as you exit. We'd love to get your feedback to hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.